Good afternoon and welcome to another round of Tab Radio Finance Session, the online broadcasting platform at the Asian Banker. In this session, we will be sharing some updates on the trends and developments in digital banking. These findings are based on our recently concluded Excellence in International Retail Financial Services program, a benchmarking exercise that identifies not only the best player in retail banking, but also to identify key developments and issues each of the markets under coverage are facing. As you may be aware, the coverage of the Excellence program spans across Asia Pacific, Middle East, and Africa, and evaluates more than 150 players in retail banking. We will first start to present the overall key developments in digital banking. This will be followed by tracking the rise of digital banks in the Asia Pacific, Middle East, and Africa. Third, we will put some spotlights on two major regions, India and China, and how they fare in digital adoption. Last, we will end with some insights into the state of digital selling among commercial banks. Executives in retail financial services are reeling under the forces of disruption. They often have to prove to their board and shareholders that they are ahead of the curve, ahead of the client, and ahead of financial technology or fintech. These demands are accentuated across an even ever wider interconnected circle of businesses, ranging from wealth management to payments and collaborative partnerships among regulators, fintechs, and banks. Industrial boundaries, once clearly demarcated between telco, banks, technology providers, are ossifying. In their effort to change, banks put a lot of gunpowder into digital transformation. By aiming to bridge the gap between their services and their customers' digital footprint, large banks in Asia and the Middle East continue to invest between 50 to 90% of their retail IT budget on digital technologies. But to move large financial institutions, executives have to pull the levers incredibly hard. In some markets such as China, Korea, and Vietnam, banks are trailing technology companies which are digitally disrupting the payments and credit industry at a scale not seen in the past. For example, Credit Ease in China, which has become the world's largest peer-to-peer lender with $6 billion worth business on its portfolio, demonstrated to incumbent banks that there are new markets with huge revenue and fee income to tap into without the need of banks as intermediaries. Banks in the region aim for greater personalization of customer experience by better understanding their situation and what they are trying to achieve. A more timely understanding of customer interactions with the bank, however, requires collecting and interpreting a variety of data types in real time and at scale, a trend which is unfolding. Leading banks have completed their investment into multi-node and multi-core big data and computing platforms in combination with more traditional data mining and business intelligence infrastructure, which enables them not only to migrate high-cost enterprise data warehouse activities to lower-cost platforms, but also to stream large-scale unstructured data such as voice, clickstream data, picture, social media, and increase adoption of location-based offers, in particular in the credit card business and real-time trigger. A growing number of banks are already trying to combine 5 to 15 sources of data in their quest to create more relevant needs-based offers to their clients. The key challenge is that while banks have deep information on customers who have strong relationships, there are details dropping off for customers with lighter relationships. The goal is to identify key changes in customer circumstances, such as the birth of a child, household formation or dissolution, or changing jobs, in a timely way so the banks can proact to assist the customer. Transactional data tells the banks about these events only after the event. Progress in natural language processing and AI will make financial services increasingly voice and touch assisted. We believe that the Alexis and series of the industry will be the future in banking, even though this is a nascent technology with plenty of limitations. We have seen banks such as USAA in the US and OCBC in Asia experimenting with this technology successfully. Digital only or pure internet players have emerged in the last 2 years. Banks, which are constrained by their own legacy systems for local or regional expansion, opt to spin off their digital only platforms altogether, at times in conjunction with a different core banking system and management team. Compared to Europe and the US, Asia has seen very little pure non-bank mobile or internet-only players being launched in the last 2 years. More than 80% of these digital-only neophyte banks are owned and run by commercial banks. In mobile payments, banks are pursuing a mix of own closed-loop, proprietary, and third-party platforms. Mobile wallet adoption is not yet on a scale that is material, at best a fraction of digital base, and based on the excellence findings, banks' own wallets often lose out against cards and wallets for Alipay, Android, and Samsung Pay. While banks often lose out against larger technology players in mobile payments, recent data from Kenya is indicating that a unified bank-wide payment system that enables small value transfers between institutions has proven successful in competing with large technology firms in micropayments. Many people are aware that within a couple of years of M-Pesa's launch, the total number of mobile money accounts in Kenya eclipsed the total number of bank accounts. Yet, since 2015, bank accounts once again outnumbered mobile money accounts by over 30%, driven by the PesaLink, a real-time payment system rolled out by banks. One key emerging focus banks have been discussing with us in Excellence is creating ecosystems, which they hope are much harder to replicate. This implies not only creating lifestyle ecosystems for customers that go beyond mere product selling, but also to play, compete, and cooperate within a wider network of fintechs, regulators, e-commerce platforms, and non-bank financial institutions. The rise of cross-sector digital partnerships will not only be opening new revenue sources, but also harness big data to reconstruct more accurate customer identities for authentication, know your customers or KYC, and credit scoring. To create those ecosystems, banks need to better harness network effects to allow customers to easier access a broader range of products and services outside the bank's traditional digital channels, and to collaborate with the third parties to develop and market an increasing number of product variants through open application program interfaces or APIs. It only means to transform the value-price relationship, much like what Amazon Web has done by shifting pricing from fixed upfront pricing to performance and usage-based pricing and bundled product and services to tailor fit for its clients or client segment specific needs. The Asian banker research has seen first steps in these directions among the leading banks in Asia, Africa, the Middle East, but the vast majority has yet to take on this future. Digital-only or pure internet players have emerged early in Asia too, and they continue to operate successfully, such as UBank by NAB or National Australia Bank and ING Direct in Australia, or some of the early internet-only banks of the like of Sony Bank, NetBank, which were often part of larger conglomerations. There has been a second wave of neophyte digital-only financial institutions in Asia in the last 2 years, as the map illustrates. Outside Japan, they have emerged from nowhere in a relatively short period of time. Most 2-year-olds or younger are about to come in the market, such as the pure digital bank of CIMB Malaysia, which will be launched in its digital-only bank in Vietnam by end of 2017. Digital-only players come in different forms and combinations. Many lean towards payments as a key business proposition. Others are mobile or internet players with a limited branch network. Some have traditional parent banks behind, such as Timo in Vietnam, which is powered by the back office of VP Bank, Jibun Bank in Japan, which is a joint venture between Bank of Tokyo Mitsubishi UFJ and the mobile network operator KDDI. Or there's Digibank in India and Indonesia, which is owned by DBS in Singapore. In the UAE too, most digital-only banks are owned by traditional commercial banks. Others have originated from popular messaging applications such as KakaoTalk in Korea and WeChat Pay in China. Many of the digital banks use new technologies to confirm the identities of clients and to meet know your client requirements. In theory, digital-only banks could radically transform the financial services landscapes of the countries in which they operate. But for most, licensing, scale, and profitability are the three key issues they face going forward. One of the early successes was Jiban Bank in Japan. The bank broke even within 4 years of market inception in 2012 and relied heavily in the first years on their mother company client base. The bank accumulated more than 500,000 new customers in its first year. In 2015, the bank reported 2 million mobile banking accounts, the highest number of mobile banking accounts in Japan. In terms of productivity, the bank is able to cater to its customer base with about 200 employees. DBS Singapore aims to scale up its retail banking presence in China, India, and Indonesia using its digital platform called DigiBank. The success of DigiBank India will impact DBS decision-making process on how to proceed on its market expansion efforts. The bank aims to acquire more than 5 million bank accounts in India with DigiBank in the next 2 to 3 years. Momo in Vietnam, which is a mobile wallet solution by M Service, which became the largest airtime top-up provider for all the telcos in Vietnam, has 2 million registered mobile wallet users by end of 2016, owning approximately 7 to 80% of the mobile wallet market. Its fee-based revenue model is based on merchant charges and the mobile wallet service. Momo's customers comprise roughly of about 50% mobile wallet users and 50% over-the-counter clients served by its agent network. It has a network of over 5,000 independent agents, through whom customers can load cash into their accounts, make withdrawals, bill payments, and other financial transactions. It plans to grow its network eventually to 11,000 agents and more than 7 million active e-wallet users. With its extensive user base and digital capabilities, it was not surprising that Tencent launched WeBank in 2015, the first online bank in China. The company received a license to operate from China's banking regulator together with 5 other institutions, including Alibaba. Although it struggled on its first year, reporting a net loss of about $82 million from May 2015 to December 2015, WeBank recovered in 2016 with a net profit of $5.9 million. This is mainly driven by microloans lent to blue-collar workers and small entrepreneurs in the country. In Israel, the Leumi Group, the country's largest financial institution, launched Pepper in July 2017, an entirely mobile-only application without branches and no current account fees. Pepper's onboarding process takes in enough information to underwrite loans purely on the mobile platform. In South Korea, 2 domestic digital-only institutions, one operated by telecom company KT and the other by the country's dominant messaging app Kakao, are signing up new customers by the millions in 2017. About 300,000 new accounts were opened with the Kakao Bank in the 24 hours following its launch in late July 2017, more than traditional banks in South Korea get in a year through online channels. With more than 4 million bank users by end of 2016, it is about 10% of its registered user base. Rival K-Bank, the country's first web-only bank, has attracted just over 500,000 users since its April launch. However, pure telecom-run mobile banks failed elsewhere in the past. A case at hand is the well-established telco brand T-Mobile, which was unable to make a mobile banking proposition work in the U.S. in 2014. The combination of a payment card and a mobile application that gave customers the opportunity to bank through their phones failed to resonate. If we look at the total digital accounts by the largest technology companies vis-a-vis the commercial banking industry, commercial banks are falling increasingly behind. This is not only happening in China and India, but increasingly so in Korea and Vietnam. Front-end technologies, better user interfaces, and relevant offerings made technology companies overtake the combined strength of commercial banks. As for China, there were approximately 900 million mobile banking subscribers in 2016, and mobile banking accounts by commercial banks will overtake internet banking accounts in 2017. Please note that customers can have more than one account, so the data reflects this. India's mobile banking accounts are only a portion of China's account volume, or about 9%. For India, about 70% of the internet access is through mobile and the rest through desktops. Enablers for fast digital penetration is a decrease in cost of delivery to customers and a fast turnaround time, 24/7 banking, personalized user experience, and ease of use. Interoperability of the payment system in India would be critical for the further success of digitization. The other key part is that banks and payments processors are able to offer a competitive rate to merchants in the processing of small value transactions. In most cases, those rates are not compatible to what merchants are willing to pay. The Unified Payments Interface created by the National Payments Corporation of India is a technology platform that will be the basis for ensuring interoperability. With a high portion of digitally active retail customer base, banks address the needs of an increasingly tech-centric customer base. Globally, best banks have reached already the 70% ceiling in regards to active digital customers. Top banks in the Excellence program acquire more than 35% of their total customers, retail plus SME, via digital channels. In the same vein, the best banks are able to acquire between 15 and 25% of their affluent base via digital channels. First-tier banks in developed markets handle on average 17% of products digitally end-to-end. The ratio is even lower when it comes to the contribution to total gross income from retail banking. We have most banks in a small range between 1 to 3%, regardless whether they are operating in mature or emerging markets. In addition, banks struggle to offer end-to-end digital sales for new-to-bank customers. Exceptions are countries with strong national ID infrastructures, such as Korea, Taiwan, Australia, and Japan. Those countries have also seen banks moving into selling of more complex products such as insurances and mortgages online. In emerging markets, financial institutions are moving fast to introduce end-to-end digitized services too. Cases at hand are VP Bank in Vietnam and CIMB in Malaysia. Since 2015, VP Bank has built up a substantial position in the consumer finance market with a market share of 60%. The bank initially launched an online origination for lead generation, but has moved quickly into an end-to-end digital process. This includes online disbursal, which is fully integrated with the credit bureau and its core banking system to allow certain segments to approve loans in less than 10 minutes. The bank expects between 40 and 60% of all new bank applicants to be processed with this fully automated process. CIMB Malaysia originates and processes close to 50% of all consumer finance loans via digital channels. Its web and mobile platforms are fully integrated, and systems are integrated directly to the host system, and transactions are processed on a straight-through basis. As for 2017, we will see the extension of full straight-through process digital sales capabilities into digital current account openings and remote deposit generation. From paperwork, multiple signatures, and having to access dozens of systems, the relationship opening experience at branches varies by markets and even within the same bank. In its effort to standardize and automate the back and front end processing further, banks reduce account opening time to a few minutes and afford more time for the relationship manager to engage with the customer. Most Australian banks are already offering those options, but an increasing number of banks from the UAE to Taiwan are working on this. CTBC Taiwan offers conventional account opening at the branch within 15 minutes, including filling forms, KYC, and document processing. The bank uses optical character recognition identification technology for identity card scanning and automatically detects column information through imaging in the application form. In 2016, the Taiwanese banks launched online account opening in 4 steps, including the upload of certification of documents. To some of the key takeaways from this TAB Radio Finance session, while digital is becoming core proposition, banks find it hard to make radical changes. In most cases, banks spin off their digital-only proposition based on separate core systems and management. Compared to the Europe and the US, Asia has seen very little pure non-bank or mobile internet-only plays launching. More than 80% have banks or messaging applications behind them. In theory, digital-only banks could radically transform the financial services landscapes of the countries in which they operate. But for most, licensing, scale, and profitability are the 3 key issues they face going forward. Cards and wallets still make up a tiny fraction in overall payments. Those platform works well in mature markets with high credit card penetration, but for emerging markets or other payment solutions are required. A series of national payments agendas is aiming to standardize the payments and speed up adoption into micropayments. Increasingly, QR code payment platforms are becoming the platform of choice. But the key question is, can China's success in micropayment based on the QR code framework be replicated in other markets in ASEAN? Lastly, first-year banks in developed markets handle on average 17% of products digitally end-to-end, but eventually aim to bring more than 80% of all services and products online.
Thank you for joining us again this afternoon. This session is uploaded in our website www.theasianbanker.com. You may also find there are other past radio finance sessions. And we look forward to having you again in our future radio finance program.